Hey, good afternoon once again, Market Rebels, and welcome to our trading tune-up. So if you've been with us last week, you know that I announced that we are going to only go to 1 day per week, and I'll talk a little bit about why that is in just a moment. But this is going to be just the only time this week, and for the weeks going forward, which is going to be on Monday at 4 p.m. So before we get started, a couple of things. I want to wish everybody a very happy Halloween. And in keeping with that theme, we're going to kind of do a topic on that today. But also, as I mentioned, we're only going to Mondays for trading tune-up from here forward. And we did that because we have to make room for a brand new service that is called Coach's Corner. And what we're going to be doing is highlighting one or some combination of our coaches to show you some of the techniques that they use to help traders make better decisions. It could be from big picture perspectives, psychology, setting up strategies, hedging, rolling, morphing, all the things that people really want to know about, but you're going to hear about it directly from our coaches. So looking forward to that. You get to it in exactly the same way. Just go to YouTube, Market Rebellion, click on the bell, just like you do here, and it will start on Thursdays, 4 p.m. Eastern Time. So in keeping with our Halloween theme for today, I thought we could talk about another scary topic, which is early exercise with calls. Now, the reason I call this a scary topic, it's one that really confuses traders. They just find it just going, oh no, we're not going to talk about this again, because they find it really, really confusing. It's not that bad. But the reason it's super important is that it comes up a lot. Are there times, or maybe there are times, that you are looking to get the shares, but people make the wrong decisions about when and why they should exercise? So that's what we're going to talk about. So to kick things off, I wanted to set the stage a little bit. Interesting story that happened to me, and this will really give you better insights into what a call option is. So years ago, I worked for a very large brokerage firm it was called an active trader options team at the time. And I did a 3-month rotation at what was called the trade support desk. And the trade support desk is almost like an internal court system, little arbitration panel. So a client might call in and say, hey, I never bought this, or the broker entered the wrong symbol. We'd have to go and pull the recorded phone calls, listen to it, and make a decision about who was right and who was wrong. So I did this for a 3-month rotation. It was absolutely very interesting, but one that still stands out. This guy calls up and he says, I ordered, let's say it was IBM, and the broker instead transposed some letters and put in, let's say, BMI. And he said, that's not the stock that I wanted. So again, we pull the phone calls, we're listening to it going, yep, Mr. Customer, you're absolutely right. Broker error, there's 2 things we can do to resolve this. Number 1, we can remove the trade, put all your money back, including the commissions, as if it never happened. Or number 2, if you decide that you would like to keep this stock, we'll let you do that. We'll remove the commissions, and we'll also, just as a customer service gesture, and maybe give you a free trade in the future just for the aggravation. So what would you like to do? And he thinks about it for a second. He says, well, you know what? I was researching this stock when I found out about it, and it actually looks like a very interesting company. Could I have 3 days to think about it? Now, even though I can't hear you back there, I have a feeling a lot of people are immediately smiling and laughing, going, there's no way. And the reason you're thinking there's no way is because you realize that's asking for a free call option. He wants the right to say, hey, you know what? If the stock goes up, I'll call up and say, yes, I want it. And if the stock goes down, no shocker there, he'll call up and say, no, I don't want it. So he has really just a free call option. He can only gain, he can't lose. The broker is carrying all of the risk for no gain. So once you realize that, it gives you a different perspective that when you have a call option, you have the right to exercise and get the shares. You also have the right to walk away. And that's something that most traders completely forget. And that's really kind of a way to set the stage for early exercise. Now for today, we're just going to be talking about call options. That usually comes about more often than it does for early exercise of puts. So to start the presentation, we have to talk about there's really 2 conditions, whether a stock pays dividends or not. So we're going to look at a case where a stock pays no dividends. Now that doesn't mean that the stock is a non-dividend paying stock. Maybe it just paid a dividend yesterday and you've got a 2-month option. So in other words, it's not going to pay a dividend while you're holding the option. So in those cases, that's what I'm calling the stock paying no dividends. The second case is if the stock does pay a dividend. Now, the first case, if the stock pays no dividends, this is the easiest case of all. It is never optimal to exercise a call option early. It is never going to benefit you. All right, you've always got the ability to exercise at any point in the future, up to and including the expiration day, and pay the same amount. But there's actually a couple of other reasons that escape people as to why it's not a good idea. So let's take a look at our risk graph. This is our classic hockey stick graph of a $100 call, right? There's our bend at 100. And this one I have showing cost $5. Now, if we have shares of stock instead, let's say trading for 100, that would be our risk graph, right? We would cross right there at 100. Now, notice that if we hold the call option in blue over the long stock in red, we are getting rid of all of the downside risk. That's the big benefit, or certainly one of the big benefits of holding the call option. However, when you exercise, what you're doing is saying, you know what? Forget about that. I'm willing to take all of the downside risk. You're kind of swinging that door, so to speak, that flat line right here, and opening up the downside. Notice you still have 100% of the upside. That doesn't change. You're just increasing the downside risk. Now, it gets even worse that if you exercise, in this case, this is $5 of extrinsic value, so your cost basis effectively becomes 105. So you're actually paying more than the current value of the stock, because when you exercise early, you are throwing away the extrinsic value. You can't sell the call and exercise it. You get one or the other. So as soon as you exercise it, you're waving goodbye to that extrinsic value. In this case, your cost basis is 105. You've opened up the downside risk and you got nothing for it. All right. Once again, you could always wait, whether it's tomorrow, next week, next month, next year, and still pay the same $100. There's no reason to do it early. So when you exercise a call option early, it's really a triple whammy. You are accepting the downside risk early, you're losing the extrinsic value, you're just throwing it away, and then you're also losing interest. So in this example, let's say it was it's 100 shares at $100, so that's $10,000. If it's a 1-year option and you exercise it early, you're paying $10,000 for that stock today. If you exercise it in 1 year, you're paying $10,000 in a year. So if you take that money out early, which remember is providing no benefit, and buying the shares, you're also not earning interest on that money. So that becomes why I'm saying that you are losing interest. Now, yeah, it's true in today's pretty much zero interest rate environment, that's not going to be a big issue, but certainly accepting the downside risk early is, as well as losing the extrinsic value. All right, so hopefully that clarifies that if you have a stock that pays no dividends over the life of the option, the decision is easy. Do not exercise early. That's not saying that you can't exercise, just wait until expiration to do it. Scenario number 2, let's say for dividend-paying stocks. So if the stock price, to understand a dividend-paying stock, we have to understand some of the mechanics. Realize that the stock price is reduced by the dividend on the X date. So if you have a $100 stock that pays a $1 dividend tomorrow, would be called the X date, the date that it is trading without the dividend, the stock will open at $99. All right, so that's going to be part of the mechanics that you have to understand. So with dividends, if we have a stock that pays dividends, it may be optimal to exercise early. And that is a key word right there, may. I've heard a lot of traders saying, oh, the stock is about to pay a dividend, so I know I'm supposed to exercise. Wrong. It might be optimal to exercise. All right, so just because a dividend is being paid, don't jump the gun and say, therefore I must exercise. You got to go through some of these calculations we're going to talk about. So to understand why, realize that the call's value is made up of 4 components. You've got, well, I should say 3 components, really. It's the intrinsic value, the extrinsic value, or the volatility, plus the cost of carry, or the interest. But if there are any dividends, they subtract from the call's value. So if these dividends get big enough, yeah, it might make sense to exercise it early. But even in those cases, you want to exercise as late as possible for the reasons that we just talked about. So you'd want to exercise the day before the X date. So another thing is that the call trading at parity is a necessary condition before exercising, or at least maybe within a couple of pennies. So recall what parity is. If the stock is 110 and you've got the $100 call trading for 10, in other words, it's all intrinsic and no extrinsic value, it's trading at parity. Parity is just a fancy word for equivalence, and at that point, it's exactly equivalent to shares of stock, right? If I exercise that call, I've effectively paid 110, and if I buy the stock, I'm effectively owning it at 110. Two different ways of getting exactly the same thing. So that also means that the call and the stock have a delta of 1. So if you've got a delta of 1, it doesn't really matter, but you're not opening any of the downside risks that we talked about before. So you're saying, okay, well, if that's true, and I got delta 1 in both cases, I might as well grab the dividend. This is another way of understanding why that's got to be trading at parity, or at least really, really close. That delta's got to be very close to 1. So let's take a look at some examples. Let's say the stock is 110, $100 call is trading for 10, and the stock pays a $1 dividend. If you don't exercise, what happens? Your $100 call is now going to be trading for $9, because remember, the stock's going to go to 109. It's going to lose the value of that dividend, and therefore it's going to have $9 of intrinsic value. So you're sitting here going, well, that's not such a hot deal. What else could I do? Well, if you're looking to take the stock and you exercise it, you're going to get the stock, right? You'll pay 100. Tomorrow it's worth 99. So you lose $1, but then you also gain $1. So the interesting thing about exercising early is not that it's some kind of a financial windfall. It's really just to keep you from losing. It's a loss prevention strategy as opposed to a financial gain. It's just to kind of keep you whole. So, but keep in mind that you're opening up all of that downside risk. Now, what would happen, let's say, if the option had extrinsic value? All right, we said that $10 was trading at parity. What if it's trading for 11? Well, if it pays a $1 dividend, if you don't exercise it, you're just trading off the dividend for the insurance. And mathematically, the insurance is said to be worth more than that dividend. You know, you let that stock gap down 20%, you're going to see it wasn't such a hot deal to exercise for that dividend. Also keeping in mind that a lot of dividends are really small, maybe 20, 30 cents. So that would be a reason for saying the insurance is worth far more than the dividend. But if you exercise it, your effective cost is now 111. You're better off just closing it. You'd be better off because you're effectively paying 111 for stock worth 110. Why are you overpaying for $1? Because you're throwing away the $1 worth of extrinsic value. So even in a case like this, if you did want to grab the shares, close the call, grab the 11, and then turn around and buy the stock. All right, so that's why, again, showing that it's optimal to have that option trading at parity, just intrinsic value, or at least really, really close. So hopefully that gives you some better insights about why and when to exercise early. If you're ever in doubt, it's probably safer to not do it or ask somebody, but definitely make sure that you don't exercise just because you hear that a stock is paying a dividend. So as I always mentioned, it's always about going from good to better to best. And the way that you do that is to practice and to have somebody by your side who can give you these tips and tricks, trading strategies and ideas much, much faster. And that is with a coach. So if you would like to speak to somebody free of charge, can't beat that, you can get a free one-on-one 30-minute consultation with one of our world-class coaches. Phone number is 888-809-8058. Give them a call and they would be happy to speak with you about any topic you'd like. And you will be surprised at how much you can learn when you are talking one-on-one with a professional coach that is custom tailoring the conversations to your needs. So again, I hope that helps. It is a common source of mistakes that we see a lot. And we will see you hopefully on Thursday for our very first Coach's Corner, which will be featuring Stu Dorfman. So we're looking forward to that. We got a really good presentation for you, and we hope to see you then. Thank you so much, everyone.